very interesting papers here. So first, I'd like to ask a couple of questions of you, Prithu, about your findings. So, again, just broadly in a frictionless world, the identity of the lender should not matter. It should just be about seeing all the positive NPV loans, and you provided some compelling evidence to say that the identity does matter. But I'm interested to know your thoughts about a little bit more about why is it true that they matter, and thinking about the channel. And something I had in mind that kept coming to me in the presentation while I was reading the paper is this about banks' willingness or ability or skills to take these investments, or perhaps is there some other demand factors? And by demand, I don't mean necessarily local profitability, but I mean comfort and willingness to apply, okay, to a bank where I know that I feel like I'm going to get a fair shake.
Right. So that's an excellent question. And I've spent some time, as you can understand, thinking about, okay, can I pinpoint to this one thing which will explain everything? But the point, Taylor, is that every MDI is different. But the point is they're all mission driven. So for example, and Dom is going to talk about his MDIs, but for example, there's a MDI, Asian American MDI operating out of Manhattan, Chinatown. Now, majority of their customers are, waiting tables in those restaurants. And the big part of their income is the tips that they make. Now, to convince FHLB to accept tips as a proof of proper income takes some doing. So this is one example of an MDI going out of the way to make sure that their primary customers are able to get home loans, even if they have a slightly sketchy form of regular income. So yes, I think it's the willingness of the banks to go out of the way. But unfortunately, in terms of theory, I find as many theories going around as there are number of banks. So I would just like to say that mission-driven lending and their willingness, as you said, on the part of the banks to particularly help the kind of customers they serve is probably driving this thing.
Have you taken a look at application rates? Do you see actually the applications in the area are going down as far as more like discouraged applicants?
So what I showed in my one of the, so not applications rate, but what I do find is that if an MDI is overtaken by a community bank, it is not the case that the denials are increasing substantially more. By that, what I mean is that once relationship is lost, I'm finding some role of search friction, some role of frictions in forming new relationships with the new owners. So it's not as if everyone is just going to apply to the new bank and they are getting denied. So it's not the corporate strategy that I find explaining my results.
Yeah, so along those lines, you talk about as an interesting anecdote there of using the tips as a form of income. So have you considered looking at what the banks actually do with the loans? So this might suggest that those are the types of loans that the GSEs may not have an appetite for. So have you looked and seen, are these do you see the balance sheet loans, so to speak, that are disappearing when you see these closures?
So that's a great suggestion, Taylor. I'll look into it in more details. I'm doing something with the loans that are getting sold to FHLBs, not the bigger GSECs, but FHLBs. But sure, I can explore that direction somewhat more.
Yeah, and sort of my last question I have for you, Prithu, is, to the extent that it is this sort of willingness to lend or special technology that these MDIs have, it was striking the figure, the diff and diff sort of figure that you had that showed over the long term, these are like 6 years out, there is still this gap. And I'm just wondering, were you surprised that this gap doesn't dissipate over time? What do you think it is that's stopping new lenders from coming in and filling that gap?
I've thought about it. There's previous literature that also shows similar findings, but then they're saying credit markets are pretty local. It is also something that I need to look more closely, but what I'm settling down on is there are some frictions in forming new relationships by the erstwhile borrowers. Now, how to prove it, there can be a couple of different ways I can think about it, but that's what I'm settling on, some kind of search frictions in the credit markets.
Very good. So I think that's kind of a good transition over to a couple of questions that I have for Adam. So turning to him for a minute here. You know, one thing that I think is fascinating here is, you know, the study of competition. And in other industries, you know, competition we think of as being an unambiguously good thing. But in banking, we know that, you know, there may be some risk that's happening or some race to the bottom that might be happening. So all that to say that the effects that you find, they're not immediately obvious. And it could be the case that in light of sort of soft information and repeated interactions, that more competition could actually lead to worse outcomes. So just sort of an observation that, you know, it's surprising and important results. You know, your paper is more about sort of market level measures of competition, but I'm wondering if you've thought any or looked at sort of the extent to which the constituents themselves in the market matter. And what I mean by that, or what I had in mind is, you know, these mergers are typically going to be done by larger banks. And so I'm wondering if there's sort of more to learn here to the extent that there might be some sort of big bank effect coming alongside this concentration effect. And what I mean is big banks we know have higher denial rates. And so I don't know if you see that sort of similar pattern with fees, but to the extent that the large banks are coming in and creating the concentration and they also charge higher fees, you know, I'm wondering if that could potentially contribute to some of the estimated differences here.
That's a very good point, and thank you for raising this. I think the first thing you said was, how should we think about the general welfare effects of competition? And you're correct. There's a long history of finance research that says, well, maybe the credit supply effects of competition is ambiguous. Maybe what we need is local strongholds of banks to develop relationship lending. So there's a lot of theory papers that say actually credit supply will increase for small lenders or for startup firms if the local bank has a monopoly. They can develop these relationships over time. And at least on the credit supply side, we find that that's not the case in mortgage markets. So almost unambiguously, more concentration leads to increased credit supply. That's sort of point number one on welfare. Point number two on welfare is it's not always the case that increased credit supply is better for welfare. And we have to be very careful making that statement. It might be the case that there are some borrowers who are not credit worthy, who in the long run would be better off if they weren't extended credit. So there's a lot of discussion about, well, to what extent is increased credit supply a result of predatory lending. So I don't want to make the statement that increased credit supply unambiguously is a good thing. I think by real preferences, many of these households are better off, but it can potentially lead to sort of financial instability. That's sort of your second question was on the composition of banks. And I think that this is very important. We've seen the landscape of mortgage lenders change dramatically over the past 20, 30 years. So it used to be the case in many financial markets in the, say, the mid-90s that banking was a one-stop shop. You went to your local bank in your state and you got all of your banking products from this bank. This is the bank where you had your checking account. This is where you had your credit card. This is where you got your mortgage. Now those markets have been split up and often taken by either bigger banks, as you mentioned, or by non-deposits taking so-called shadow banks. So much of the mortgage lending today is done by non-deposit taking banks. So there's been a disconnect between market presence in the local area in terms of taking in deposits and extending credit. I don't have that figure right here, but I've done some research looking at the correlation between deposit taking and mortgage lending, and it is indeed the case that over the past 30 years, that correlation has gone basically to zero. So there might be a case to be made that in 20 years ago, the local bank had more of an interest in extending credit and revitalizing the local area. But if we only have national banks and maybe even have national shadow banks that don't take deposits or don't take small business loans, they don't have the same vested interest in the local neighborhoods. That'll be the last I'll say to this comment.
Yeah, and so that actually opens up, and I'll try to be brief here before we turn it over to Dom. But you make a good point. The big elephant in the room here is the non-bank competition that are in there, and I wonder if you have thought, kind of as we talked with Prithu, an area that they may not be able to compete is on balance sheet lending. So to the extent that these banks might be able to exercise some sort of market power and extract rents from potential borrowers, then perhaps looking at sort of your non-conforming type applicants, you might see that these effects are more pronounced.
I agree.
Yeah. So with that, I'm very keen to hear what our community bank discussant Dom, what his insights and experiences are in these areas and the questions that he might have for our presenters. So Dom, it's over to you.